Hi, it's Professor Mike, and we're talking about Chapter 12, Assessing Control Risk and Reporting on Internal Controls. So back to the audit risk model. Remember, audit risk equals inherent risk times control risk times detection risk. Inherent risk and control risk are the responsibility of the company's management. Detection risk is what the auditor solves for in order to make sure that they've reduced the audit risk to an overall acceptable level. So the first step in assessing control risk is obtain, document, and understanding of internal control. So we need to understand the design and implementation of controls that are relevant to the financial statements to identify and assess the risk of material misstatements. Word material, again, material misstatements, not immaterial. You do not care about immaterial errors or fraud as it relates to internal controls or misstatements, okay, if they're immaterial in the aggregate. So there are four steps in assessing internal controls, right? Obtain and document your understanding of internal control design and operation. You'll assess control risk. You'll test controls, and then you'll decide your detection risk after you've tested controls. Now you will plan your detection risk based on your planned internal control risk assessment. But what you will do is adjust your detection risk based on the actual outcome of your testing of internal controls. One key thing to note, this will be on a quiz, many quizzes, is that your internal control risk must be reduced to less than 1 if you're testing internal controls and if those tests come out that internal controls can be relied on. If you're assessing internal control risk as 1, then you do not test internal controls. Basically, efficiency is merely intelligent laziness. If you're not going to reduce your substantive procedures because you're not going to rely on internal controls, you have no reason to test them. If you're required to test and report on internal controls as part of an accelerated filer as a public company, a larger public company, then you should be relying on internal controls to reduce your substantive work. If you're not, you're either doing too much work or the internal controls are not appropriate and working, and you should modify your internal control report. Okay? So, how do you document an understanding? You'll use narratives, you'll use flowcharts, and you'll use questionnaires. The firms all have these things, and most of the time, when you have a continuing audit engagement, you've had the client before, then these will be continuing documents. These will not be start from scratch documents unless you're accepting a new client or there's been significant changes in the client. And then how do you look at what your documentation says the controls are versus what they really are? You'll do a walkthrough. You may do inquiries, but in addition to inquiry, you need to do observation. Just asking is not enough. You need to go look at something or walk through a transaction or inspect documents and records. And then, also look at entity level activities and operations. There's a whole bunch of different types of controls that you can have. A budget to actuals are a great control on financials, a great control on spending, a great test on revenue. You can have non-financial metrics that give you really good information about financial results. You know, if you're looking at things like engagement levels, customer satisfaction scores, things like that, that can give you ample information about controls. So don't just think about controls as, somebody puts initials on something or somebody tests something. There's a bunch of different controls that can be broadly defined and can be extremely effective in preventing and detecting material misstatements. So again, you obtain the understanding, you document that, you assess your control risk, then you test the controls, then as a result of the test of controls, you modify your detection risk and substantive risk that you have already assessed in the planning phase. So assessing control risk. You start by making that preliminary assessment in the planning process. It's, what do you expect controls to find? Are they going to be so effective that you're not going to find many errors? Um, Strong controls may be things like Netflix subscriber controls. Well, how many subscribers would have to have an error for then Netflix to have material error in the financial statements based on subscriber information? It'd have to be substantial. So, you want to know about the various controls that they have in place for subscription pricing and things like that that could affect everybody. But an individual subscriber control is probably not as important. Okay, the we'll use a control risk matrix to look at the different transactions, and it's a convenient view to look at things and decide, okay, how risky are these different transaction flows, and how likely are they to result in material misstatements? Um, these all relate to audit objectives and assertions. So it's about identifying the existing controls and then aligning those controls with the individual audit objectives. So the next thing we'll do is we'll look at whether key controls were absent, whether the design and implementation really errors. A lot of times companies will continue doing controls, or individuals will continue doing controls even though they've implemented new systems or processes. So those controls are no longer effective. One of the best ways to test for this is for an effectiveness of a control is to say, when did you find an error? Because if a control never finds an error, then either the company is operating perfectly or the control isn't really operating so that it's going to find errors. Or some other control is finding errors before it, and therefore the controls may be duplicative, and therefore the second one may be unnecessary. There are three levels of absence of a control. There's a control deficiency, a significant deficiency, and a material weakness. And we'll get into those in a little bit. Okay, so you identify the existing controls. You find where there may be absence of the controls. You consider whether there's possible compensating controls, like a bank reconciliation may be a compensating control for a lack of a control in a cash management application, for example, when you're applying cash to invoices. But the fact that you're doing a bank reconciliation may actually compensate for that. So you've got something later on in the process that will find errors. That leads you to figuring out, okay, do we have a significant deficiency or material weakness? And what kind of misstatements could happen if you have that? So here's, material weakness is, the worst case scenario. I've issued material weakness letters in the past, and I actually had, we had a client engagement where the company was we gave it material weaknesses in revenue recognition. The company then terminated us, replaced us with another set of auditors. The SEC in their to disclose the fact that we had identified a material weakness in their revenue recognition process. Immediately after going public using the other auditors, they missed their earnings estimates and had some improper transactions, which had been highlighted by our material weakness letter. Had they fixed the controls that we identified in the material weakness letter, they would not have had those transactions. And therefore, the company and the successor auditor got sued. That's material weaknesses are very big deals. But you will see companies that do have significant deficiencies, which are, not as not as likely to result in a material misstatement in the financial statements that remains undetected. So that's where the design of the system is not operating as you would expect it, but it doesn't necessarily result in a material financial statement misstatement. Okay, tests of controls. So we're required to test controls if we're either issuing an opinion on internal controls or if we're relying on internal controls to reduce our substantive test work. Again, if you're going to test internal controls, you should be reducing your substantive test work. Your detection risk assessment should be higher. Otherwise, you're doing more work than you need to. So the procedures that you would do to test controls are inquiry and observation. So examine a document, examine a record, examine a report, look at control-related activities, and reperform client procedures. You could use audit data analytics, including tests of controls, and you can use it as a test of details also, because it could also provide evidence about effectiveness of controls. How much do you do? Well, part of that is the assessment of risk, right? If you've reduced your control risk, in other words, you've made it a much lower number so that controls will find more errors, then you've got to do more test work, okay? There's always the inverse relationship between the amount of test work and the risk assessment. So remember, for detection risk, if detection risk is 0.1 or 0.2, then that means a lot of audit work. If detection risk is 0.6, that means not a lot of audit work. Same thing goes for controls. If it's a 1, it's 0 audit work. If it's a 0.2 on controls, you're heavily relying on controls, therefore you have to do a lot of testing. Okay, how much can you rely on prior year's audit? How much is automated versus manual? How much? How significant are the risks from a financial statement standpoint? And then how much of the period are you testing? Because you're relying on controls, but you can't just test them once at the end of the year, for example. You need to test them throughout the year to make sure that they were effective throughout the year. That's what controls are. Controls are ongoing things, right? There's test of controls. The testing of controls has an overlap between gaining that understanding, right? So both of them involve the inquiry, inspection, observation. So you can take credit, but the difference is that the procedures are going to be more rigorous in testing, and you will have sample sizes and timing changes in the tests of controls. So you're actually going to do some sampling here. This is the view of the textbook on the different levels of work that you do for each of these. Obviously, you're going to do a lot of inquiry when you're gaining an understanding, but the inquiry will be more limited when you're doing testing, right? Because you need to do observation, you need to see documents, you need to do walkthroughs in order to rely on the controls. To obtain the understanding, which is required even if you're not relying on controls, not relying on your, not reducing your substantive test work, you're still going to go through this inquiry, inspection, observation. Okay. So then you decide your planned detection risk after you've done your test work, and the risk assessment you'll review and make sure that the control risk assessment that you outline really is supported by your tests of controls. So the auditor is required to report on internal control to the audit committee, the board of directors, management, whoever is appropriate given the structure of the company. They must communicate significant deficiencies and material weaknesses in writing to the audit committee and management. Management letters, they're not required by auditing standards, but generally, as a client service, auditors will provide them. They're usually comprised of less significant control-related issues or operational improvements that they see that don't rise to the level of significant deficiencies or material weakness. And usually these are reflecting the fact that the auditor sees many different companies throughout the year and is got an objective viewpoint and some ideas about best practices. Also, it can be the implementation of new accounting standards or other things as well. So management letters are a form of client service and a form to provide recommendations based on the auditor's experience, but they don't substitute for the communication of material weakness or significant deficiency. For accelerated filers, we have to provide an audit report, as we've seen in prior chapters. And the scope of that is similar to the scope of a regular audit, right? It's limited to having reasonable assurance, again, those two words, that material weaknesses in internal control are identified. So things that are going to impact the financial statements to the extent that it might change somebody's viewpoint on the financial statements if the controls were effective, right, and identifying things. So the types of opinions, obviously, you can have an unqualified opinion. There are no identified material weaknesses and no restrictions on scope. Again, just like no material issues with GAAP, no scope restrictions. Adverse, you have a material weakness, qualified or disclaimer, you've got a scope limitation. Okay, excuse me. And then for non-public and smaller public companies, the understanding is smaller, and you don't have the reporting obligation, but you do have the requirements to, if you're going to reduce your test work, you have to do testing of internal controls if you're going to reduce your substantive test work. But you have to have an understanding over internal controls over financial reporting. Okay. Again, IT we talked about in the last chapter, but the complexity is there, and you cannot simply treat IT as a black box. So if documents exist only electronically, you've got to audit through the computer, not around the computer. That means running transaction tests, understanding how the company tests its transaction flows, all these kinds of things. We may run test data, we may run parallel simulation, we may use an audit tool that can run and test the stuff. A lot of the firms have proprietary audit tools to run test scenarios. The other thing that you will do um, in a lot of companies, especially like your financial systems companies like NetSuite, Workday, SAP, those kinds of things, where you don't have an installed application, but you're running it on the cloud in the SaaS environments we've discussed earlier, you will get a letter. They will have outside auditors review their systems and their system controls, and you will obtain a letter from them annually that states that they've had an independent audit of their system controls and that their systems and controls are appropriate and in place such that you don't need to test them for purposes of issuing your financial statement opinion. Okay, this is fairly common. You know, the software, there's generalized audit software that you can use to make audits much more efficient, running test data through, and stuff can, automation is far faster than going through paper trails for any of you. So the more you can automate from an audit perspective, the better it is, and the more interesting your auditing is, because I can tell you, having gone through paper audits, that part is not fun. And if the firm can use tools to test things, you should by all means use it. Okay, this is kind of a diagram of these tests. We won't, I won't quiz you on these, but this is just to give you some information. If you're doing a parallel simulation, you'll run your audit program separately. So you can see, we used to have to actually manually foot reports. Footing means adding stuff up, for those of you who don't know it. So now, system tools will add up the accounts receivable trial balance. You can do tests to make sure that all employees are terminated, and compare access rights to a bunch of different systems to terminated employees to make sure that there aren't any terminated employees that still have access to systems that they should. Okay, and then also the audit software can do your sample selections for you. This is a big deal, right? You don't want to have to go through and pick stuff. You'd rather rely on a tool to make those selections for you based on parameters that you've given it. This way, if you're ever in court, you go back and you say, our firm's software was the item that selected the sample size for these confirmations, and then the plaintiff has to argue that something was wrong with the firm's software, and the firm is going to spend millions of dollars on investing in testing and updating that software. So it's highly unlikely that there's an error in the firm's software. Where there can be problems is where you override the firm's software and apply your judgment. So then your judgment is being substituted for the firm's software. And that's a harder defense for you as an accountant. Okay? So that's chapter 12. On to chapter 13.